Hi, everyone. Thank you for tuning in and welcome to this presentation of Redesigning the Treasury Function for Future Growth, brought to you by Bentleys. My name is Hassie. I'm an Associate Director in our Innovation, Technology and Strategic Advisory team here in Bentleys, Queensland, and I will be a moderator today. As we all know, the current aged care sector is highly competitive with rising costs around quality of care, workforce, and infrastructure. Given the funding challenges that exist within the current sector, it is ever so important to ensure financial and treasury management functions are defined and refined. To discuss the redesigning of the treasury function for future growth, we have Heath Shonhan from Bentleys, Queensland. Heath is a business advisory partner specializing in health and aging sector. Heath, thank you for your time today.
Hassie, it's great to be joining you.
Fantastic. Hey, before we jump in, I think it is important to acknowledge the unprecedented times that we live in, given the current COVID-19 pandemic. Hey, I know you've been busy for the last few weeks on the phone, assisting and advising many aged care service providers. What are some of the main concerns, thoughts, or questions that they are reaching out to you with?
It's coming from a scenario planning and business continuity planning perspective, Hassie. So the main driver of profitability, one of the main drivers of profitability within a aged care context is occupancy. And aged care here in Australia, particularly residential aged care, has a number of industry peculiarities. One of the main ones being that residents and consumers provide a material amount of the capital funding that an aged care provider needs to fund the infrastructure of their service provision. So when they start to think about occupancy, and the associated consumer funding, their scenario planning then starts driving them into the areas of treasury management.
Yeah, that's fantastic. So tell us about treasury management function and how to redesign it.
Yeah, okay, Hassie. We're fortunate we work with a whole range of leading providers around the countryside, and the really forward-thinking ones at this point in time have moved past their scenario planning and starting to work on the actions and the what ifs around that. And so we thought it'd be relevant to share a case study with everybody around not only the method to go through to redesign your treasury function, but also what then some of the tools and the tool that you should have in your toolkit afterwards, and then how to use those tools more importantly, and some of the tips and the traps that then come from using those tools, because we just felt that one of the best ways that we can help the broader aged care sector at this point in time from a financial perspective was to really help them to work through and understand their treasury function through a really topical case study. And remembering that some of the key drivers around doing this right now are scenario planning and the associated impacts that a change in the consumer funding or even the underlying working capital base of an aged care provider would result from a health crisis or even otherwise. And so that's the context of this presentation and this case study. And so the first part will take everyone through the how-to, the methods, the recipe of actually redesigning your treasury function. So really in an open source type of way, giving you the method to go away and do this yourselves, providers to go away and do this themselves. And then, as I said, at the latter part, identifying them the tools that they'll come up with, how to use those tools and the tips and the traps. So that's the broad context for the next 20 odd minutes. Part of the driver and the context around this, though, that most residential aged care providers particularly will be aware of is that they have some prudential obligations under the Aged Care Act. And here's some extracts from the relevant sections of the Act and the supporting and supplementary document. And one of those requirements that providers have is a requirement for sufficient liquidity. So approved providers must have sufficient liquidity in order to refund accommodation deposits, accommodation bonds, or entry contribution balances that are expected to fall due within the following 12 months. There's no specific requirements or specific formula as to how providers are to do this. There's some broad requirements around what types of documents they must maintain, the format in terms of how they're holding liquidity, and the factors that they've used to determine the minimum level of liquidity, and then the form in which they will maintain that liquidity. The Act and the regulations, though, are silent, and necessarily so, are silent around the exact percentages. So for argument's sake, is it 5%, is it 10%, is it 20% of my total resident liabilities? And so approved providers have been conscious that they have this liquidity management requirement, and they all have a liquidity management strategy, and this is all audited. What we're talking about today is much greater than that, because liquidity will absolutely be addressed as part of treasury, but treasury also goes further and starts to think about opportunity assessment, impacts upon the organisation, and then how you actually fund those impacts. And it also addresses then how you hold your liquid reserves and also the other inputs into that. So for argument's sake, a change in funding from 1 month in advance in home care to 1 month in arrears, what that does in terms of working capital on a particular provider's liquidity strategy. So liquidity is just one component of an overall treasury management and treasury toolkit. And it's an important part. Everyone understands it because it's regulatory driven. But as I said, there's a number of other facets that we're going to wrap in today. And I just wanted to kind of touch on how what providers actually know fit into the broader piece of treasury that we're talking about today. So let's start with the how-to, so that providers can go out and actually upgrade their treasury and evolve their treasury management processes as a result of this process. And we like to use an Ecycle methodology. So the methodology that we suggest very much starts with an exploration. So start to gather all of your existing templates, all of your existing documents, artifacts, workflows, systems, as is processes. And as I mentioned, all of you will have liquidity management strategies. It's probably a 1 to 3 page documents. You'll all have some form of liquidity management calculation, and there's some of the existing artifacts that you will identify through this exploration process. Other artifacts may well be treasury management or treasury committee constitutions or charters, or even project financial assessment types of tools or board mandates. Gather all of those in the explore component of the Ecycle methodology. From there, once you've got those artifacts, we then encourage you to engage with a number of different stakeholders within your organisation. Engage with senior management, other parts of senior management, other executive. Engage with any of your those charged with governance, whether they be owners of the business, whether they be board members, specific committees that are focused around treasury or risk, and engage with frontline staff around challenges and opportunities, because that will help form how you identify what an opportunity is, as an example that is to go through this framework and incorporate stakeholders' perspectives. Once you've obtained the artifacts under the exploration, and once you've engaged with key stakeholders, we then encourage you as the third step to execute. So start to pull together a gap analysis and identify recommendations, change management strategies before moving into an evaluation. So how well has the toolkit of treasury management evolved, and then how do we enhance that through the final phase? So that Ecycle is our recommended methodology. It's the methodology we adopt when we approach an evolution to a provider's treasury management systems and functions, and it's a good methodology for those of you who want to go ahead and do it yourself. So getting deeper into that, as I mentioned before, under the explore phase, this is where we're looking at what are the existing treasury structures, processes and resources. We recommend completing a health check via a gap analysis at this point in time, and critically look across 5 key areas. What are the risk management and governance frameworks in place around treasury? What are the existing policies and procedures? What's the team structure, whether it be a large organisation or a small organisation, where this function is just one component of the overall role of somebody? What is the structure and what are their capabilities? What are the existing personnel, training and performance requirements? And then how is treasury reported and performance measured? From there, as I mentioned before, engaging with board and management before moving into an execution phase, where you start to then, as a result of that gap analysis, upgrade the policies and frameworks. More than likely, this will include some form of overview of the documents in the toolkit. We recommend that it includes an overall treasury and investment management strategy to cover off on items such as your gates of assessment for investment, the types of risks that you will accept, the forms of liquidity and that you'll hold your investment horizons and your buckets, which I'll explain a little bit further. You'll absolutely need some constitutional documents, particularly a charter then for the Treasury Management Committee. You will all have a liquidity management strategy. I would suggest that you'll be completing some updates and some evolutions to that based on your scenario testing, based on future as opposed to historical, incorporating some of the contemporary pieces we have around occupancy levels and perceptions around aged care and residential aged care and the impacts that has on occupancy. And then you may well end up with a range of additional templates and supporting documents depending on your size and levels of capacity and capability. For larger organisations, in the toolkit that we recommend, there certainly is a management representation letter from managers involved in actually quitting the responsibilities of treasury management up to those charged with responsibility. Certainly a notification of breaches, form and register, risk and funding report, and some treasury and liquidity management checklists and reviews. As part of then the evaluation cycle, you will absolutely be completing a 10-year forecast, looking through past the current health crisis and into the evolving economic and financial challenges that will then permeate around as a result of reduced capital flows and reduced capital cycles, whether it be a debt and an equity perspective. You will have a buckets calculator, and I'm going to talk further about the buckets. I'm going to talk about your minimum level of liquidity calculator, your weighted average cost of capital calculator, and then one of our favourites, the project financial assessment tool. Before, testing with management and then updating on a regular basis. And that completes the methodology. So as I said, that's the how-to. What you end up with afterwards as a result of going through that journey is the toolkit that we're sharing with you here. And really the toolkit for a comprehensive and forward-thinking treasury management function within any aged care provider has a suite of policies and has a suite of tools. And the policies, as I talked about, treasury and investment management strategy, the Treasury Management Committee Charter, the TMCC, the liquidity management strategy to acquit your core regulatory responsibility under the Aged Care Act, and an implementation plan as to how and when these policies will be reviewed, updated and used. Those policies will be supported by the actual detailed calculators, so a financial calculator to work out the project financial assessment and your horizons around cash flows and future cash flow forecasts. Minimum level of liquidity calculator, so you can compare and contrast what your requirements are against how much you have in each of the three buckets that we'll introduce to you very shortly. And as I mentioned, the policies over on the left-hand side of your screen that you look at the moment, there's some detail there as to actually what they're governing and why they're absolutely necessary. So for instance, the Treasury and Investment Management Strategy is your overarching document around roles, responsibilities, financial risk management and reporting requirements. Your Treasury Management Committee Charter, again, goes deeper into who's on the committee, what their membership skills and competencies are. Your Liquidity Management Strategy, as I said, acquits your regulatory requirements and it looks at the calculation methods, the building up of your operating segments. And we encourage you to go much further than just looking at residential aged care with this document, but also to cover your home care operations, any retirement living operations you have, as well as your broader business, basically your whole balance sheet. Before an implementation plan, which outlines the steps to get from current state to future state and the iterations in between. The financial calculator, as I mentioned before, is the whole suite of looking at your buckets, your minimum level of liquidity, as well as importantly, a high level forecast, looking at your cash inflows and outflows. The project financial assessment is that tool for conducting a first pass analysis of your opportunities used in gate one. Your minimum level of liquidity is looking at your operating segments, home care, residential aged care, retirement living, and then the buckets, which we're about to move into, but broadly looking at asset regeneration, funding your defined liabilities, and looking at growth funding. So let's talk a little bit more about these buckets now that we've talked through the method of going about evolving your treasury management, and then we've talked about the toolkits or the outcomes that you'll be seeking as a result of that evolution. Let's talk now about the impacts of that. And we really like to divide and simplify the balance sheet in this methodology. We accountants like to create lots of confusion around assets and liabilities. Are they current? Are they non-current? What's retained profits? What goes into the balance sheet? But for the purposes of treasury management, let's look at the balance sheet really simply. Let's define it into 3 buckets. The first bucket being asset regeneration. And this is for board members who aren't financially minded, but really get to understand this bucket concept. So firstly, asset regeneration. The nature of this bucket is looking at the capital expenditure on your existing assets. So think property, plant and equipment, land and buildings. How much do we need to spend on a yearly basis to regenerate our existing asset portfolio? Commonly, a useful first reference point for that is depreciation. That non-cash outflow that you see in your profit and loss statement every year. So that's bucket number 1, dealing with asset regeneration. What do we need to do to spend to regenerate our existing fleet? The second bucket is a really easy bucket to understand. It's right, well, how much do we need to provide for our defined liabilities expected to be repaid within the next 12 months? This is covering off on all of your resident liabilities, but it's also thinking about your employee entitlement liabilities, dealing with all of the liabilities on your balance sheet that are current and putting them into this defined liabilities bucket. And this really helps you acquit your minimum level of liquidity requirements for your liquidity management strategy under the Aged Care Act. But as you can probably understand, it goes much wider. It starts to think about not just residential aged care and not just being able to repay our RADs, but also thinking about being able to repay our entry contributions for our retirement village assets, to be able to fund our working capital, and to be able to fund our employee liability. So all of our major liabilities are captured within this bucket number 2. And then bucket number 3 is growth. This is your available cash or financial assets then to be able to identify in growth and or risky activities. The purpose of this bucket is very much to be able to identify what surplus cash do we have left to invest in non-core activities that support organizational growth. That may well be acquisitions, that may well be new computer systems or new softwares, or it may well be new different types of business units. But really that's the bucket that's left over after you've regenerated your assets, covered your liabilities, and are now looking for growth. And as I mentioned before, this really enables non-financially minded board members and senior management to understand the concept and engage in the concept of treasury management by simplifying the balance sheet into 3 buckets. I'll repeat them: asset regeneration, defined liabilities, and growth. And let's look a little bit more in terms of what that might look like then. So as I mentioned, asset balances are the focus of bucket number 1. And in this example, de-identified example, consider an organisation, an aged care provider that has $240 million of land and buildings. It has $2 million invested in information, communication and technology assets. It has $8.5 million tied up in plant and equipment, including vehicles, and a further $1 million tied up in software. All balances extracted from various line items in the organisation's balance sheet. We, as accountants, then put some form of depreciation rate or amortization rate against these assets. And so, as an example, typically software is depreciated at 25%, meaning you're writing off that software every 4 years. Plant and equipment, assume an average useful life of 5 years, provides you with a depreciation rate of 20%. ICT assets, again, generously assuming a useful life of 5 years. These will be things like hardware, servers, infrastructure, cabling, etc. assume a useful life of 5 years. Some will be longer, some will be shorter. Comparing that to say $2 million in that asset, over 5 years, that's a $400,000 write-off every year. As I mentioned, $8.5 million worth of plant and equipment written off over 5 years is depreciation of 1.7 a year. $1 million worth of software written off over 4 years, or at 25% is $250,000 a year. And buildings then, $240 million worth of buildings written off over 20 years, or 5% per year, provides an annual depreciation of $12 million. Depreciation is a non-cash item. We get that you don't physically pay the cash, but what it is economic consumption of the use of that asset. And the pure economic thinking is that if you're consuming your assets, then you need to be providing for the replacement of them, either in increased repairs and maintenance expenditure or physical cash outflows versus new asset acquisitions in the form of replacement assets to maintain your existing fleet and regenerate your existing fleet. The discussion comes in here around, 5% depreciation for buildings. You're saying then that they're only going to last for 20 years. You'd like to think that your buildings last for longer than 20 years. History has shown that certainly over the last 20 years, with radical changes in models of care, in consumer requirements and consumer expectations, the average useful life of buildings has actually been around that 20 years, certainly the insides of the buildings, and particularly when you then start to need to reconfigure doorways or size of rooms or move from 4-bed dorms down to single rooms, can very easily understand why we've gone for a 20-year useful life. This is just one way, and we'll get into the tips and the traps of calculating this, but this is just a very simple example that everyone can start with. There's evolutions of this. You can go and get quantity surveyors to actually give you a full schedule of replacement of your buildings and give you a full 30, 40-year annual CapEx replacement cost. For this example, we just wanted to make it very simple and say, right, well, let's use existing information that everyone should have as a reference point, and you make your own calls around what depreciation rate you will then levy against those asset values. Using this example, noting you can refine it as I mentioned, but using this example, you end up with a bucket one annual requirement of $14.35 million. So that's how much bucket number one is saying is required to regenerate the assets every year. Extending that example then and looking at bucket number two, this is where we're starting to look at our defined liabilities. And this is where we start to look at how we're going to regenerate and fund our liabilities. And let's assume that we've done some analysis around our resident liabilities, and we've actually calculated the annual requirement for a residential aged care service as being $13 million. So we might have said, rightio, well, we have a total liability to our residents of 130 million, and we're going to provide, based on historical patterns, 10% at any one time we need in liquidity. Again, as I mentioned before, there'll be a range of ways to actually calculate that. But under this example, we've actually said, rightio, well, let's use $13 million. With the retirement village, we've then said, rightio, let's provide, again, using this example, we've got $110 million worth of total liabilities or resident funds under management. So let's provide 10% of that balance on historical patterns as being how much we need to hold in liquidity. Then in home care, we've got a large amount of unspent funds, or we need to provide for additional working capital to enable the change of funding from being in advance in home care to being in arrears at some future point. And then, because we're a conservative organisation, we like to also keep an amount of money, call it 8 weeks of outflows, in our working capital account to cover immediate cash outflows. So then to fund, under this example, our liabilities, we're saying that the total segment is $33 million. And so that's the value of our minimum level of liquidity that we need to fund bucket number two. If we further extend this example and say, okay, well, as at the date of doing these calculations, we had $44.1 million in cash. It says we need 14.3 at any one point in time for our bucket number one to regenerate our liabilities over the this current piece. We also need $33.7 million worth of liquidity to fund bucket number 2. So really, we have a deficiency in this bucket of $3.95 million. That number will either be positive or negative depending on how much cash you have in the bank. For the purposes of this example, we thought we'd run with, okay, a negative deficiency so that we can look at ways to refill this bucket up. Here's another graphical way just to look at the same data. Bucket number 1, $14.3 million being a function of the regeneration requirements for our buildings, our ICT, our software, our plant and equipment. Bucket number 2 being $33 million being a function of how much liquidity we need for a residential aged care service, how much liquidity we need for a retirement village, how much liquidity we need for our home care service, and how much liquidity we need for our other employee entitlements, operational funding, etc., coming to 33.7, and resulting in, if we had $44 million worth of cash, 14.3 in bucket 1 and 33 in bucket number 2 gives us the deficiency we identified before. So what do we do when bucket number 3 is empty? And this is where we then start to scenario plan, Hassie. So we've moved now from the method of evolving your treasury management function. We've moved into the tools and the techniques, and we've now started to really test this 3-bucket theory and look at then, okay, well, what happens if our growth bucket is empty? So we're covering our assets, we're covering our liabilities, and as you can see, this expanded form of treasury is much greater than just simply having a minimum level of liquidity. It's starting to deal with asset regeneration as well as covering our defined liabilities, and then saying, okay, well, now what do we have left over for growth? Let's assume, because 50% of the sector is currently losing money at this point in time, let's assume that you've got an empty bucket after you've done this calculation. Your balance sheet really says that you've got 2 options. You can either get new forms of debt capital or get new forms of equity capital. The new forms of debt capital, if we think about this at a macro industry level, the opportunities here are to either have longer dated debt, such as some form of corporate bond, or to have some reallocation of the consumer debt, the RADs, the entry contributions, against a different asset, so land and buildings, as opposed to, and therefore it being coming from a bank, as opposed to coming from the consumer. So you either get a longer form of corporate bond type of debt, or you reduce your consumer debt and you increase your bank debt. That's really the 2 major solutions, or the macro opportunities under solving this bucket number 3 by getting a different form of debt. Not really achieving much because it's just reshuffling the deck chairs. What we favour is, over on the right-hand side, requiring new forms of equity. And here we're really talking about either getting more retained profits from different operations. For example, licensing the brand or use of your intangibles, or commercializing a separate startup innovation is one format which gets extra alternative income in. And this is over and above retaining profits on an operating basis, which is another form of equity retention. The other form that we're increasingly testing at this point in time is around some form of community cooperative REIT. So rather than, and practically the way that this looks is some form of sale and leaseback, but rather than going to a corporate, a large REIT of some form or another, or an international REIT that is providing money for land and buildings to go into a trust where you then lease that, one form of new equity which we're starting to test and would be interested in feedback from everyone around on would be a community cooperative style of REIT, whereby you monetize the value in your lands and buildings and turn it into a current asset from non-current by doing a form of sale and leaseback. But it's a REIT that perhaps you as a provider is also an owner in, and perhaps your residents or communities that you operate in are also owners in it. The advantage to them is that they get to have ownership of an asset and an asset class that they may not otherwise get access to. It provides them potentially with a return which is different to their other returns that they might be getting. And I have to, at this point, interject that this is not financial advice in any way, shape or form. This is just scenario planning at a very general level, and is certainly not personal financial advice for anybody. But this community cooperative REIT has a number of advantages. It involves community into the provider. It provides the aged care provider with some liquidity and valorizes their financial assets, the land and buildings, and provides returns back to community, as well as the provider, if they're an equity owner in it as well too, is giving them an ongoing tenure. So this is really a way to try and fill up bucket number 3. Some tips and traps just very quickly before we wrap up, because we want to make sure that those who are viewing this webinar can really practically operationalize the method, the tools, and the outcomes that we're talking about. So I mentioned before, bucket number 1, asset regeneration. We defaulted for the purposes of this case study to use depreciation rates. Another alternative, once you've done MVP number 1 by using your depreciation rates, is to actually go and engage with a quantity surveyor to derive future replacement costs discounted back to net present value. So going and doing a 50-year view and coming back and saying, actually, you know what, we don't need to provide for 5%, because when we've broken up the building, we know that the hard shell represents 80% of the cost, and we can change the internal fit out from a 4-bed to a 1-bed for being 20% of the costs, as an example. So that's tip number 1, to evolve the number that comes out of your bucket number 1. Bucket number 2 is around how you calculate the liquidity and within the defined liabilities bucket. And we're absolutely arguing that you need to very much include retirement living and independent living liabilities within this bucket. Also include the home care calculations as well too, in addition to the other component to this bucket, which was employee entitlements and working capital. The reason why retirement village and independent living unit consumer funding liquidity is becoming more and more omnipresent is the number of states, Queensland leading the cab off the rank, has now mandated mandatory buybacks within a time period. And so if the unit hasn't been on sold, then the scheme operator needs to buy it back within a time period. And we can see that flowing all across Australia. So the form in which you calculate the liquidity is another way. We used a very simple example just before of 10% of your total liability, consumer liability. Practically, when we do this with clients and providers, there's a few other different types of ways that we calculate that with you. Looking back at historical turnover patterns, involvement of actuarial assessments around future requirements, and inputs, emerging inputs into this area around a drop in residential property prices, so a decrease in the affordability of new money coming in, as well as an increase in the time taken for that new money to come in to replace an outgoing RAD. So both of those inputs absolutely change that very simple 10% that we talked about before, because not only will you may have less money coming in as a result in dropping residential property prices into the future as the traditional metrics aren't there to support it anymore, but also the time to actually bring in the new money is a key input into this defined liability bucket. If your RAD and capital funding tide is going out, what do you do? Assuming a 15-year wash is a big question. The stage of maturity of your site portfolio is another big question that you need to incorporate into your minimum level of liquidity. Are you in a stable portfolio? Are you in a ramp-up phase? So they're two key areas as well too that go into minimum levels of liquidity. Some other tips and traps. We mentioned before at the outset a PFA tool, a project financial assessment. The purpose of this is to provide a high level and consistent approach around assessing your opportunities. Anything that is an incremental income or an incremental expense to your organisation really benefits from this first pass through the project financial assessment. And outputs should be both quantitative, so the physical project value, NPV, IRR, cash flows, and how they align to organisational goals, as well as qualitative project value. So a project score involving an accept or reject recommendation that incorporates mission and identity if relevant. Here's an example of what goes into it. It really does talk about alignment to strategy. It gives you those high-level financial outcomes, as well as some level of mission and qualitative outcomes in alignment to service delivery or cultural bias, or even cultural sensitivities. It really should be used whenever there's an opportunity. And an opportunity, according to our definition, is anything that involves investing or allocating funds into something which may enhance value. So anything that increases cash flows, decreases cash flows, or achieves cost savings is a use case for this. And we accept that not all projects are not business as usual. And so you may want to put some thresholds around, okay, well, rather than do this for everything, should we set a hurdle rate of $100,000 or 200 or whatever your organizational size is? Or is it a percentage threshold whereby anything that materially alters the form in which liquidity is held would be removed? And then finally, certainly we've tried to, through this presentation and case study, give everybody an understanding of the method to go through, the tools that you should be aiming for, the tips and the traps that come out as a result of current state, but then also what we really believe is that a lot of these tools can be automated using current technology such as Microsoft Teams. So they can be pinned in Teams and become very live documents. And we've had some success at creating and making sure that these tools and checklists are live and can be used within Teams. And here's a snapshot as an example of the bucket calculator, which can then be used as a really good collaboration tool. That's what I'd like to cover off today, Hassie. Welcome any questions around this as well too.
Thanks for that, Heath. I did have a couple of questions. At a board level, what are the risks of not having a defined treasury management function?
We see a couple of key risks that are occurring and that are actually occurring when we come in and we do that first step of our gap analysis health check, Hassie. A big one is the inability to make decisions. Is this an opportunity? Is this not an opportunity? Another big risk is around allocation of capital. So capital and treasury decisions being made without going through a proper process, either because the projects are liked or not liked without a true basis of assessment. And ultimately, really what Treasury is going to is around use of the capital, the financial capital that an organisation has, and the best and highest and best use of that capital. So they're two key risks that we see. And of course, not having all your money in one form of assets is another key risk as well too. So there's portfolio risk that comes into it.
Yeah, sure. Just another last quick question. What is your advice to providers who may not have, I guess, dedicated resources such as treasury analysts to do these kind of work?
We've tried with this case study to give the simple approach for those who don't have that. And so that's where, as an example, we default to really easy reference points like, depreciation as an example. And we've tried to give through this presentation the method, the how to do it. We certainly, for organizations that don't have the full time or even the resources to do it, there's a couple of options. Certainly scale down the toolkit, so you don't need charters and you don't need minutes and you don't need, but you definitely do need the calculators, and you certainly should be using the project financial assessment tool. You need your minimum level of liquidity from a regulatory perspective anyway, so there's no change there. What we've just tried to do is actually give everyone an enhancement of what that looks like. And of course, all of these tools, Hassie, that we've been through today, they are available for purchase as part of a toolkit or individually as well too. So if providers want to do it themselves, then this toolkit is available as well too.
That's fantastic. I think that's all the time we have for today. If anyone has any questions with regards to how we can help with redesigning the treasury function or even refining these existing treasury strategies or the function itself, please do reach out to us. Our contact details will be displayed towards the very last slide. But thank you again, Heath. Thank you for your time, and thanks everyone for joining. Stay tuned for next one. Cheers.
Thanks, Hassie. Thanks, everyone.